an immediate overlay of sustainability factors. Are your cash flows actually sustainable? Is your weighted average cost of capital sustainable? Is your growth sustainable? What are your growth assumptions and what could affect that? And also for many evaluations, particularly on DCF, quite a lot of the evaluation hangs on the terminal value. And someone somewhere needs to really drill into that, look at the assumptions underlying it, and make sure it's not just a plug number to make the project work, and it's actually got some substance behind it. For the CFO, one of the key things when, if you like, marketing your business to the financial markets, to the investment community, is to balance between accounting measures such as EPS and other things, and economic measures such as cash distributions and absolute return. As I suppose, I am also a chartered accountant, but as a treasurer, I tend to focus on cash. But you need to be able to balance the two and to make sure that your investors are confident that you are driving the business in the right way for them. Raising the money is, I suppose, a core treasury competency and puts the practical perspective on theory. In one of my earlier slides, I think I had a little bullet point saying financial engineer. Part of the treasurer's role is to do all sorts of complex technical calculations to actually design what you're going to do, get the documentation agreed, do all the technical stuff, the tax, and the bank accounts if need be, all the transactional stuff. But then, having done all the design phase, just like an engineer, you roll up on site, and as an engineer you end up with a whole load of blokes, some plant and equipment, and you're actually going to build the bridge, the road, the water supply, whatever it is, from the set of plans you've been slaving over for the past 2 years. Treasury is very much like that. So it's not only the technical, where do we get the funds from, equity, debt, and all the rest of it, but it's actually doing it and persuading people that your project, at the rates of return you can offer and can afford to pay, is more attractive for those investors than putting their money elsewhere, which is kind of the conversation we've just had. What can you do to sell your business to the investment community? I want to spend a little bit of time on this next slide. In a way, it's a very simple slide. It took us probably, 2 or 3 years to develop it, and we still ruminate over it at the moment. It's really about the whole risk question. And we found it helpful. One way of looking at a business is actually to look at a business in terms of just one gigantic risk management engine. And investors expect you to take a set of risks from which you're going to earn profits, preferably return extra cash, in excess of, or at least meeting, their investment return criteria. Anything that you're going to make money from is a business risk, and that is your business. Anything that isn't your business and that you don't aim to make money from is your investors expect you, by and large, to get rid of somehow, to manage away. And you can do that through internal controls, or you can do it through the financial markets, take out insurance, whatever. Earlier this morning, we've mentioned this whole thing about governance, risk, and control. The way we've kind of got to look at it is that this whole package on this slide is, if you like, the government's aspect of it. It's your risk package that you are delivering to investors, and even wider than that, your stakeholders, such as your employees, your customers, your suppliers. Governance, in a way, is your brand in the financial markets. And if you think about a brand is the perception of a promise made and delivered. And I think that can be quite useful for you when you're thinking about, well, how does risk management, how does governance stick together? And of course, internal control is everything that's in place to deliver your risk management package overall to your stakeholder community. And of course, it leads neatly into the concept of enterprise-wide risk management. You can't just take one slug of risk and manage that to death, because it will impact the rest of the business, and the rest of the business will arguably be out of control. You have to do the whole thing together. And of course, Treasury's core expertise is in the management of financial risk. If you get this right, and again, we've had questions on pricing in the last session. If you get this right, communicate this right, and you are, I wrote it down, consistent, trustworthy, transparent, and you disclose, you should get accurate pricing of your projects. I won't say you will get it, but you will certainly trend towards it. And you may have to ask around and ask competitively, but it will be what you can get. On actually how to control risk, I mean, some notes I've made is really, again, you have to start with the business strategy, because that's absolutely key. Your business strategy contains your business risks. So, and that goes back to the first question we thought about, which was what to invest in the first place. You need consistent internal and external definition and communication of, depends whether you want to call it risk appetite, I think is the word I like better, or you can be a bit more defensive and call it risk tolerance. But everyone has to buy in, and it's really important that people who take risk, which is everyone in the organization takes risks, they take so in the company, in the firm's format, not with their own risk preferences. You need to have a look at some benchmarking, have a look at what conventions are in your sector, what are your competitors doing. We've heard earlier about the grey market, if not the black market, as being a major competitor in Pakistan. And you can't avoid that, and you have to compete with that. You have to win customers off that market. It's not enough just to hope someone will legislate against it. You've actually got to be there, you've got to be more competitive than they are somehow. A risk management committee can be very useful. It might only be 2 or 3 people. It doesn't have to be a good deal, but if it starts pulling in risk management right across the organisation, because it's a team effort. Treasury specialism is financial risk. A common trap that treasuries fall into is to manage financial risk in a complete silo without reference to the rest of the business. So you guys need to make sure that Treasury talks to everyone else in the business. And finally, I've got a note here saying at the end of the day, you want to be running the business and not spreadsheets. We've mentioned sustainability before. Investors are increasingly aware of sustainability, and again, the panel just now has been discussing around that point as well. And it's not just the green issues on carbon and everything else, it's how sustainable is the business model. Is this project going to run right out? If I'm a lender, will I definitely get repaid? If I'm an equity holder, what is my long-term return from this? Doing the right thing, which is down to professional judgment from you guys and your CEO. Doing the right thing has a value attached to it. If you communicate that correctly to your investment community, you will get credit for it. And you can get your treasury people thinking about sustainability because they look forward. Treasurers should always be looking forward. It's a forward-looking mindset. They understand the cash, or they ought to. They understand the business strategy, and they are comfortable with uncertainty. And all these things go to play to help you build a sustainable business plan for the future. This is the next slide, which is virtually nearly the end one, as I'm getting hungry.